Greetings and welcome to the latest edition of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners re-domesticate out of volatile legal and tax environments like the formerly golden state of California to more predictable pro-entrepreneurship, pro-growth jurisdictions. Today, we are discussing the recent and startling admission by Congressman Ro Khanna, whose name vaguely reminds me of Khan from Star Trek lore, that the so-called billionaire tax, which is, by the way, on the ballot in California this November and which will almost certainly pass, will, if he has his way, be extended down to cover $55 million of net worth. And he is surprisingly cavalier that in his vision, they won't stop there. The message is clear. If you are a business owner or high net worth individual still in California, what are you waiting for? Time is running out to evacuate the state. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. The California ballot measure was, wink, wink, marketed as a tax on billionaires. That is a 5% levy on assets, not income, assets exceeding $1 billion with a B dollars, affecting approximately 250 people in the state. That was the pitch. That was the lie. On July 2nd, 2026, Congressman Ro Khanna published an essay, so this is not a secret, in which he stated that the tax must not stop at billionaires, it must reach centimillionaires. His proposal, co-sponsored through Senator Elizabeth Warren's ultra-millionaire tax, which won't pass at the federal level this year, but probably will pass in the future if you're paying attention to trends, would impose a 2% annual federal wealth tax on net worth, not income, above $50 million every year, on top of every other tax already paid. So they're moving the goalposts from 1 billion to 50 million in the span of 6 days. If you don't believe me, go do your research. The bill text contains provisions that should concern every business owner in California and frankly, everyone in the country. The IRS would be directed also to audit at least 30% of all taxpayers subject to the wealth tax every single year. That means a much larger IRS than exists today. The agency would also, and this really grinds my gears, the agency would also receive expanded authority to arbitrarily assign values to private businesses, farmland, art, and other assets that do not have a public market price. The FATCA style third-party reporting would also be wired into the enforcement framework. This is Big Brother. And for anybody who decides to leave a proposed 40% exit tax on net worth above $50 million, I'm sorry to say, the writing is on the wall. This probably will happen at the federal level at some point, definitely within my lifetime. The exit tax is not a withholding mechanism. It is a penalty for departure. Now, there is already an exit tax today. This is expanding the existing mechanism. Senator Warren's bill does not prescribe how the revenue will be spent. Make of that what you will. The spending wish list rather appears in the press release, not in the bill text. Okay. The threshold has not been increased or indexed for inflation since 2019. When the bill was introduced, its sponsors stated it would reach only the top 0.05% of American households. The 2026 reintroduction now has coverage of the top 0.15% or approximately 260,000 households. Remember, with inflation, your money is worth less every day. This is one of the consequences of that. The 2026 reintroduction now covers that top 0.15% by the sponsor's own analysis. The coverage tripled without a single amendment. Asset inflation did the work. A provision buried in the bill doubles the top rate to 6%. Get this, in any year that qualifying trigger legislation is enacted. It's not stopping at 50 million bucks and it's not stopping at 3%. The ratchet is already there. The international precedent, and there is one, by the way, is quite instructive. Norway's wealth tax now applies to net worth above $160,000. That is lower middle class in the United States. That's where we are headed with this. The Netherlands taxes deemed returns on assets above worth approximately 57,000 euros. Again, these are low numbers. The European wealth taxes that remained limited to the wealthy were modified and repealed because they did not generate sufficient revenue. And the ones that did survive, so there is a definite survivorship bias in effect, did so by reaching further down the income distribution. The pattern is not a theory, it is a documented outcome in every jurisdiction that has attempted this model. Where do you think they're going to get the money to pay for universal basic income, which is coming? For business owners in California, the timeline is frankly panic-inducing. The state ballot measure goes to voters this November. The author of the state ballot measure has stated on camera, on the record, this will not be a one-time tax. Go listen to him. He's telling you in his own words. And a sitting congressman from California has now stated that the threshold must drop from 1 billion to 50 million. And the exit tax in the federal proposal is 40%. California conducts aggressive residency audits through its infamous franchise tax board. The window to redomesticate an entity if you are a business owner and establish residency in another state without an income tax or wealth tax is rapidly closing. Remember, Florida, for example, imposes no state-level personal income tax, and most small and medium-sized businesses in the Sunshine State pay no business-level income tax. Texas is similar in both regards, and neither state imposes a wealth tax. Neither state imposes an exit tax. Those two things are about to change in California. The number was never $1 billion, although it started there. Nobody really believed that was the true number. This week it's 50 million. When will it be down to 160,000 like in Norway? The writing is on the wall and the die has already been cast. With this context in mind, redomestication is the lesser known legal process of transferring a company's state of domicile to a new state without dissolving it, without creating a new entity, and without triggering the federal income tax consequences, but only when performed with the strict formalities required under the Federal Internal Revenue Code, applicable Treasury regulations, and the statutory frameworks of both the destination and departing states. Let me stop here. California absolutely allows redomestication, effective 2023. So if your corporate counsel is telling you California does not allow it, they are at least 3 years behind the curve. When executed by a competent, keyword being competent professional, the company retains its existing federal employer identification number, contracts, credit history, and bank accounts. That is to say, there is no operational or financial disruption. And we have successfully completed redomestications from all 50 states, including California, and for limited liability companies, partnerships, subchapter S entities, and subchapter C corporations. And not to brag, but we do have a 100% success rate to date. Foreign entity registration is not the same thing as redomestication. If somebody is trying to sell you on foreign entity registration, you need to know the facts. Foreign entity registration, also referred to as foreign qualification, does not change the company's domicile. In fact, it does the opposite. Yes, really, it keeps the entity in the former state, like California, indefinitely, and merely adds a second layer of compliance obligations and tax obligations in the new destination state. Meanwhile, a traditional merger, which is also not the same thing as redomestication, creates a new distinct entity in the destination state may require the issuance of a new federal employer identification number and can trigger serious contractual and tax consequences. Finally, dissolution is a bad word. Dissolution should not enter the conversation at all because dissolution is the death penalty. Dissolution terminates the company. Dissolution is a going out of business tool, not a relocation tool. And dissolution is often a taxable event, and when performed incorrectly, can expose, get this, can expose the owners of the company to unlimited personal liability, jointly and severally, for the company's liabilities, known and unknown. If you have a so-called professional suggesting dissolution as a relocation option, please get better advice. Redomestication, when paired with a change of personal residency and this is an important and, a reduction or outright cessation of business operations in California, can reduce or even eliminate state tax nexus exposure for the entity and its owners in that state. Don't take my word for it. Ask your existing CPA. Now is the time to act before the California State House in Sacramento changes the law to hinder or even eliminate the option of redomestication. If you have questions regarding potentially redomesticating your existing limited liability company or corporation out of California or out of another state, please use the link in the description for more information on this process and to schedule time for you and I to speak one-on-one about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation, like all of my presentations, is necessarily general in nature and is not legal or tax advice, nor should it be construed as such, because that advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on this topic, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for that consultation. I look forward to that opportunity to speak and perhaps even work with you very soon.